Have you ever sat down and actually done the math on how long your money would last, without getting a giant knot in your stomach? If your savings literally had to feed you right now, not some vague, distant retirement version of you, but the real you today. Most people get that knot in their stomach somewhere around the second line of the calculation and, well, they just quietly close the spreadsheet.
Welcome everyone to Dollar Playbook. I'm Taylor Reed, and in today's explainer, I'm going to guide you through a pretty terrifying financial paradox. We're looking at why some people go completely broke while others get rich, using the exact same amount of money and getting the exact same returns. Because here's the thing, the people who run out of money usually didn't earn too little and they didn't even get bad returns. It all comes down to a hidden filter that almost nobody checks.
Section 1. The $1 Million Paradox. Paul versus Neil.
Let's dive right into this by running a proper experiment. We're going to take 30 consecutive years of real S&P 500 returns from 1995 all the way through 2024. Now we hand those 30 years of returns to two identical accounts holding $1 million each. Our first guy, Paul, receives the returns in the exact order history actually delivered them. Our second guy, Neil, receives the exact same 30 numbers, but rearranged so that the bad crash years hit right at the very beginning. They both start pulling out $50,000 a year to live on, bumping that up just a little each year to cover the cost of living. And keep in mind, they both average the exact same 10.9% return over this period.
But just look at the difference here. While Paul finishes the 30 years with a massive $9.97 million, Neil's account hits absolutely zero in year 17. Same money in, same returns, same average. Literally one single variable changed the ending, and that was the order of the returns. You see, the very moment money starts flowing out of your account instead of into it, the order of your returns stops being just market trivia. It starts deciding absolutely everything.
Section 2. The Silent Portfolio Killer. Forced Selling.
To really understand why Neil went bankrupt, we have to look closely at the specific mechanism that destroyed his account. And this isn't just a lesson for 65-year-olds. This math switches on any time you live off a pool of money while the markets move up and down underneath it. Look at Neil's first 3 years. The market drops continuously. Because he's forced to pull money out just to eat and pay rent, nearly half of his portfolio completely evaporates. Over those 3 years, only about $150,000 actually went to him for living expenses. But his total balance fell from $1 million all the way down to $516,000.
So, the crucial point we need to grasp is this fatal flaw, which we call forced selling. Selling your shares at depressed prices to fund your everyday life permanently removed them from your account. In year 4, when the market finally roars back almost 29%, Neil's balance barely even moves. A 29% gain bought him almost nothing. Why? Because the shares that should have caught that massive recovery had already been sold at the absolute bottom and converted into groceries 2 years earlier. They just aren't there when the market finally bounces back.
Honestly, the scariest part of this whole thing is that Neil was mathematically doomed by year 11, and it happened in total silence. If we ran Neil's numbers forward and gave him the absolute best conceivable order for his remaining returns, he still goes broke. From year 11 onward, he just goes on withdrawing his money for 6 more years, probably feeling roughly fine because his monthly statement still reads in the 6 figures. But he is already gone. It's a cold bookkeeping fact that becomes totally irreversible while you aren't even looking.
Section 3. The 5-year fragile window. The danger zone. To truly understand this risk, we can't just look at 2 men. We actually ran 10,000 different orderings of these exact same 30 returns. Then we sorted them by one thing only: how those first 5 years went. What we discovered is this absolutely crucial, fragile window. If your first 5 years of withdrawals happen to fall during a good market, your failure rate is 0%. Not just low, 0. But if you hit a bad stretch early on, like our guy Neil did, 1 in 5 accounts will go broke. Everything after this early 5-year window mattered so much less that it barely even shows up in the data.
This fragile window opens up exactly when money stops flowing in from your job and starts flowing out to fund your life, which means you have to prepare for it before it opens. The people inside this window almost never know they're inside it. It doesn't feel any different. It just is different. If you're currently in your 30s or 40s, your window hasn't opened yet, but everything we're about to cover is significantly cheaper and easier to set up before that day comes.
Section 4. 3 levers for survival. Building for the window.
Fortunately, you don't have to just cross your fingers and hope you get lucky with a good market order. You have 3 very practical levers to control this risk.
Let's stack these three life rafts together to see how they can completely change Neil's disastrous outcome. The whole goal here is to take the decision away from the market's random luck and hand the control right back to you.
Okay, level 1 is what we call the floor. Before your withdrawals even begin, you set aside 3 years of living costs in dull, stable cash or short-term bonds. This is money that literally cannot crash. When the stock market dips below its previous high, you live on this floor instead. That way you never have to sell your stock shares at the bottom. Applied to Neil's brutal market sequence, this floor actually buys him 2 extra years of survival, pushing his mathematical death from year 17 out to year 19.
Lever 2 is called guardrails. Instead of stubbornly pulling out $50,000 plus an inflation raise every single year no matter what, you follow a really simple rule. After a down year in the market, you cut your withdrawal by 10% and you skip that annual raise. Every single dollar you don't withdraw during a crash is a dollar's worth of shares that stays alive for the eventual recovery. On its own, this system of trimming your spending buys Neil an additional 10 years before bankruptcy.
Lever 3 is the window defense. Since we know that only one specific window is truly dangerous, only one window needs heavy defending. This is an intentional strategy where you hold fewer volatile stocks, let's say 60%, instead of being fully invested, exactly during those first 5 dangerous years of withdrawals. Once that window safely closes, you can start taking on more risk again. Think of it as extreme caution, but with a timer on it.
Let's put this all together and see how it builds. On their own, each lever fails to completely save Neil, but when you combine them, they brilliantly cover each other's blind spots. The floor protects against those short, sharp crashes. The guardrails slow down the bleeding through long, drawn-out bear markets. And the window defense shields your absolute most vulnerable years. Stacked together, they take the worst market sequence in a generation and turn it from total bankruptcy into a $3.1 million survival.
And honestly, the final results are incredibly compelling. By stacking these 3 strategies together, the overall failure rate across all 10,000 orderings we tested drops from 4.5% down to just 0.1%. That is 1 ordering in 1,000. The terrifying coin flip of market order is, for all practical purposes, completely gone.
Section 5. The price of insurance. The reality check.
But before we celebrate too much, we always have to keep the math honest here on Dollar Playbook. You have to understand that this protection is essentially a form of insurance, and all insurance has a cost during the good times. Take Paul, our lucky investor who naturally got that great market sequence. If Paul safely applies all 3 of these levers during his lucky run, he ends up with $7.2 million. So he ends up sacrificing nearly $3 million in upside just for safety. That is the premium you pay on the insurance. In the good timeline, it feels like a waste, but you only ever find out which timeline you're actually in after the fact.
And I want to be incredibly clear with everyone here. Even with these practical levers, or something like the classic 4% rule, there are absolutely no perfect guarantees in the market. The percentages we've looked at in this explainer come from a controlled historical experiment, not prophecies of the future. That is exactly why we can only say you will almost never run out of money. Nothing removes that absolute last tiny fraction of a percent of risk.
The question most people ask about their financial future is simply, how much money do I need? But as we just demonstrated, your final number can be perfectly adequate, and your ending can still be completely ruined by a bad sequence of returns. So the most critical question you actually need to ask yourself right now, while your fragile window is still firmly closed, is what exactly happens on the day your cash flow reverses?
Properly preparing for that specific day is the true foundation of building a stable life. If you found this explainer helpful, please take a second to like, share, and subscribe to Dollar Playbook so we can keep bringing you calm, clear, and trustworthy strategies. I'm Taylor Reed, reminding you that your financial future shouldn't rely on luck. Build your floor, set your guardrails, and defend your window. We'll see you everyone next time.